Hello everyone, welcome back to the channel. This is Fair Value Finder, and today we're taking a look at the McDonald's Corporation, ticker MCD. A friend of mine asked me to take a look at this one, and so I figured I'd give it a shot. Let's see what's going on here. And right off the bat, I notice some reds. The shareholders' equity is negative, definitely something that I do not like. The tangible assets are negative, which gives us a negative tangible book value. I know this is basically a real estate company where they buy the land out, they lease it, they sell product to their franchises. The company that I currently work for is a very similar model, although we do not own the land. We franchise it out to portions of existing businesses such as grocery stores. But I know the incredible growth that my company has seen. So I know the potential, but we have some highlights over here. Revenue is not growing at a pace that we'd like to see. It actually took a little bit of a dip this last year, as did earnings, but they are coming back up this year. This I just have on trend for what happened the last 3 years. Get it back up above the dip that it experienced this last year. We see the earnings yield is low. 3% is nothing crazy. So that means Benjamin Graham probably wouldn't be buying this stock. And then the Lynch formula down here, 0.46, Peter Lynch would say that this stock is overvalued. Off the bat, it's not hitting my metrics. It's not hitting Benjamin Graham's metrics. It's not hitting Peter Lynch's metrics. Definitely not something that I would buy. It depends on what portfolio you're looking for, because we can see down here there's some variation in these numbers. If you're just buying for the earnings, I mean, it's currently overpriced, probably a large premium just for the brand name itself. But the earnings and the dividend, as of the end of last year, were pretty close together in the $240 range. Cash flows, good, not great, around $150, and then the balance sheet, of course, was negative. If they're able to stay on trend, though, we'd see their earnings price jump up to $318, the dividend to almost 270, the cash flows to 165, and the balance sheet less negative, which would give us fair value of 210. It's currently trading for 290. So not something that I would touch. I would not necessarily say it's a sell. It's such a massive, well-known company that there are not widespread declines that I could recommend sell. I mean, even if we look at the expenses have been climbing, but the expenses as a portion of revenue have been dropping, 55%. Margins are healthy, 57, net of 26. Those are very good numbers. Aside from the negative shareholders' equity, there's nothing that's a major concern here. They pay out a decent dividend, 2% yield, $5.66 a year. Actually, this year, they should be paying out about $6.08 for $2 or 2.1% current yield. PE of about 26. Historically, that's been around 28. So either the market's expecting a little bit of a slowdown, which we kind of see in the numbers, or it's just a little bit undervalued from what the market currently likes. We see personally where I would like things to be. I'd be willing to pay $178 for this stock, somewhere between $178 and $194 over the course of this year, which is over $100 lower than it currently sits, 30% discount from the current price. So it's not something that I'm going to be divulging in. Their free cash flow is pretty strong, but it has been a little all over the place. The yield has moved from 27 to 24 to 30 to almost 24 again. So we'll see what it comes in at this year. Based on their average yield, they should be coming in around $6.7 billion in free cash. But I read an article today about how you should take a look at equity yield rather than just dividend yield or free cash flow yield or earning yield, where we're factoring in anything that helps the equity for shareholders. So that'd be share repurchases. Where does this stock stand on repurchasing shares? We should see the share count here. They buy about 1% every single year. And then there's the pay down of debt. Their debt actually has been climbing over the past few years. It's higher than it was in 2019, but there was a decline. There seems to be a jump from 2019 to 2020, and it's been on the decline since then. And then the dividend as well. And I will figure out a way to find those numbers and work them into our calculations here so that we can see what that is and use that as another metric to value the stocks, especially since that's what's truly driving the value to you as a shareholder. This video is just a quick little one, a quick look. I don't want to personally dive too deep because it is not in my wheelhouse. It's no value play. It could be a earnings play with the small growth that it's experienced. I don't think it's much of a growth play. It's just kind of a massive company that keeps chugging along. And to some people, that's a nice backbone to your portfolio, especially if they pay out a healthy dividend or they're good at raising their dividend. 6.17% year-over-year growth is very healthy dividend growth. I'm not at a point where that's what I'm looking for. Tomorrow are the Kroger earnings, so I'm excited about that. That was one of the first stocks that I rated a buy. I think that they have been an incredibly undervalued play. They took a hit after Costco missed on their earnings and have been on a climb since then. So if you bought in off that dip, you're sitting pretty good because I know I bought it quite a bit. So make sure you subscribe. Keep an eye out for that one. And let me know if there's anything else you want to look at. I know I'm going to be taking a look at Dollar General because that was requested. And Amazon as well. I had a friend request that. So subscribe to keep up to date. And like the video if it's a stock that you follow. Because when I'm coming back through this next earnings season, if something didn't get a whole lot of views or likes, then I might not make another video of it because it's clearly not what you guys want. I'll try another stock that you guys might have more interest in. But with that, I want to thank you for watching, and I'll catch you next time.